Okay, hello from Charles, Dr. Charles Conrick, Vertical Option Spreads, the 1.8 standard deviation solution. This is part 3 of the trading spreadsheet, lesson 3. Now today, what I'd like to do, with your permission, is to kind of take a step back from where I've been. The first two sessions has been to show you a little bit of the ins and outs of the trading spreadsheet itself. Now, what I'd like to do is to take a step back and let's look at what each particular trade means. And I'm not going to go into great detail. There's some great books on trading options. Comes to mind Anthony Saliba's books or Russell Rhodes's book, Rhoads, or Tony Saliba. My suggestion would be to go to Amazon.com. Very excellent introductory books on spread trades and option trades and trades of all natures involving options. What I'm going to be looking at here is some basics. I'm just going to show you the picture on each one. Most of you already know this stuff, so I'm not going to spend a lot of time on it. But our concept in vertical option spreads is primarily on probability theory, much more so than prediction of an asset move. For example, on television, we're all bombarded with the various trading platforms that have this system or that system, and etc. Well, that's fine. What we're looking at here is probability theory, and in perhaps another lesson or two, we're going to get down to the essentials of what's in the book, which will be my studies on the ETF SPY, SPY, like I Spy or James Bond, the Spy, and be talking about, in particular, credit spreads as opposed to debit spreads. So getting that out of our hair, for those of you that don't know the difference, a debit spread means you're going to pay for it. Money will be taken out of your account. You're buying the spread, if you will. And a credit spread just means you're going to get money credited into your account, like you sold the spread. So a debit spread means you're buying, money's coming out of your account, and a credit spread means that you sold a spread and money's coming into your account. The difference is that on a debit spread, you need to hope that the asset moves in the direction you want, um, and that you can make a profit. In other words, you buy low, sell high. On a credit spread, you're actually hoping for the opposite, meaning that you sell the spread at perhaps a couple of strike prices away from the asset, and you hope like heck the asset doesn't get out to you so that you have to buy it back. So if you bought, for an example, a credit put spread, what you're doing is buying a put and selling a put below the price of the asset. They're both out of the money puts, and what you're hoping is that the asset does not come down and you get to keep your credit because the options will expire worthless. It's all spelled out in the book, our book as well, Vertical Option Spreads. So I want you to do some reading on it as well. But the essence of all spread trading and all option trading, for that matter, is effectively a function of your predictions, your assumptions, and your call, if you will, on what the direction of a trade is. What we will ultimately get into in these lessons is the concept of probability trading, as opposed to sitting here and playing games with, well, I've got a hunch, or et cetera, et cetera. There's nothing wrong with fundamental or technical analysis, as you choose. However, um, most most option buyers are wrong. I mean, the empirical data spreads that out. I've seen a couple of different sources. Anywhere from 60 to 80% of options expire worthless, depending upon the study that you look at. So if that's true, that means that a high proportion, greater than 50% of options expiring worthless means most people are losing money. So I'm going to take you through the trading spreadsheet. You'll see on the screen I've got basically the graph or the picture of what a call option looks like. So in this case, I've got an asset priced, a strike price at 50, which is right up in here in cell C3. And if the purchase premium, the price of the option, was say $5, that would mean that your break even would be 50 plus the 5, $55. If the price was $2, that would mean that your break even would be $52. So if the asset goes up to 52 or above by the time you hit expiration, you'd make money. And if the asset went up to 60 or 70 or 80, while you hold this option, clearly just prior to expiry, you might go ahead and just sell this option, or you might even exercise it. So most option traders will simply sell the options prior to close, pocket their money, and get out. They don't want the assets, but some will exercise the option and buy the stock. So one option gives you the right, but not the obligation to buy 100 shares of the underlying the stock. Now the question would be, okay, what are my chances? And that's of course where probability theory comes in. So if we go to the trading spreadsheet, which you have now at least been introduced to, we'll set up a 60-day trade. Now I'm on tab option 1. Repeat, I'm on tab option 1. That's down here. So I'm on tab sheet option 1. And this is where we put in our setups. And I've saved us a little time by putting in 60 days to expiry and 60 days of analysis. Remember, in the last session too, I was talking to you about you could actually take days of analysis and knock it down to 10, 20, 30, whatever you wish. But in this case, we'll let it go all the way out to expiry. So both of those numbers are equal. I've put in an annual return right up here. If you'll follow my little yellow cursor, I put in an annual return of 12%. Now that's an assumption, of course, but it means that we think this asset's going up at a rate of 1% a month on average. I've left historical or actual volatility, in other words, what the volatility of the asset is, really has been at 10%. And I've put in the pink cell next door here the volatility of the volatility at 50%. In other words, what we're suggesting here is that plus or minus one standard deviation, plus or minus one standard deviation, this historical volatility will probably spend about 70% of the time between 5 and 15% with an expected value of 10. We don't know at any given time what the actual volatility is going to be. But what we can do is look at historical volatility and then assume effectively an assumption of what it's going to do. So even as we go into this, I'm going to show you or begin to show you how to use Crystal Ball. And you'll notice this is highlighted green. And I've set it up as an assumption cell so that we can take a look at it. And what that cell is doing, where it's highlighted green, and you can see the 100 right in here. What I've done is used a crystal ball assumption cell and said, well, the expected value is 100, and of course I'm dividing it by 10. Basically, that's 10% with a standard deviation of what's in the pink cell, which is 5%. So effectively, what Crystal Ball is going to do is vary this. As we run the entire spreadsheet, it's going to vary that volatility as if it were normally distributed. So that's a very useful tactic for us. Now, some of you might ask, well, why would we use a normal distribution? A great question. Can the volatility ever really be negative? You might notice down here, negative probability of, and the answer would be no. So what we could do would go to the gallery assumption and use a log normal, which might be a better pick. There's no doubt about it. My studies will have to continue on that further. So in other words, if we put in a log normal distribution, what would happen is that, and you can see what's happened, the location of the bottom will never be less than 0. And we would put the mean in as this cell right here. And the standard deviation would be the 5% right there, the 50%, the number 50. That would do the same thing. That distribution is log normal, and the volatility will never drop below zero. So we'll go ahead and leave that in if you don't mind for right now. Click OK, and I've effectively changed an assumption cell. If I get enough demand, I will teach courses on how to set up and use Crystal Ball, but that will come with time. I'm just showing you a little bit about how Crystal Ball works. So all of this stuff is based on all of the essence of Crystal Ball and using probability theory. Okay, and in this case, what I'd like to do is buy an at the money, which in this case, if the asset's trading at 50, I've got the price set at 50. Again, that's controlled by these spinners right here. You can go in increments of 10 cents. So we're going to say the asset's trading at 50. And I'm buying the strike at 50. So if obviously that can be changed in 50-cent increments, depending upon what you desire. Now you can go on any trading platform. You can go on Yahoo Finance, www.financeyahoo.com, and you can find the price of a call or a put. However, the function that controls that, as I've mentioned before, is the implied volatility. So as I raise or lower the implied volatility, you'll notice in the yellow cell down in L16, right in here where I'm playing with the cursor, that's what really controls the price. The market, you've got to look up the price. But then for this spreadsheet, what I want you to do is to go and check the price. And then what I would like you to do is to actually go and look on the option chains, find the price, and then adjust the implied volatility to suit, because that's really what it is at that particular moment. Over here, I've set up 10 options. So instead of just buying one, we'll buy 10 of them. 10 options. And don't forget, we said, or at least I said at the beginning, that I want to go long the call. So now we're going to go to tab option 4, which is right here, and set up our call strike. Right now you'll notice I've still got it set at 175.50, so we'll set this for 50. And let's say the option price is trading at 15% implied volatility. We'll drop this down to 15%. Okay, there we go. Make the screen a little bigger so you can see it. And come back to the left so you can also see it. So right now I've got a strike, I've got a long call right here. Got a long call, a strike of $50, and an implied volatility of 15%, and the call price is $1.24. So $1.24 times 100 would be $124 times 10. We're going to be going long $1,240, which is also our maximum loss on the trade. So going back to this position sheet, what I'm effectively doing is, in this case, I'm going long of 50, and this would be $1.25. And our break-even price would be at 51.25. But all you're going to lose at maximum is the $1.25 times 10. In this case, since we're buying 10 times 100. So the most we're ever going to lose is indicated by the flat line. You should know that. And our potential gain is infinite. If the asset price went up to $9,000, we'd make a fortune. Well, we're hoping it goes up to 60 or 70. So back to the trading spreadsheet and the concept of probability. We will now go back to the net sheet, and we'll click off everything but the long call, which is call buy. So by having put buy over here, put sell, call sell set at 0, we're not evaluating those. You can see the cells, of course, all turn to 0. And then by triggering on call buy, that means all we're going to be looking at is the call buy. So using this big spinner we looked at before, let's see what happens. Well, that was a good one for us. The asset went way up in value. We made $5,000. That's a good one for us. I'm trying to get one where we lose everything. There's a good one. I'll take a couple. I'm just going one at a time, looking how. All right, so there's one where we lost all of our money on this trade, roughly $125, 125 times 10. In this particular case, the asset, it went up a little bit, and over a period of 60 days, it appears that about into the 20th day, we would have been best served to take our profits and get out of this trade, because then the asset came down, the option lost value, perked back up again, but then for about the last 20 days of the trade, it started sinking and we lost all of the value in the option trade. And that's what we're looking for. What's the probability, or what is an estimate of the probability of us making any money on this long call? That's what we are looking for. Now, I've got the spreadsheet set up with Crystal Ball to do just that. So all we need to do, or you need to do at this moment, would be to go where it says start, right up in here, and click the start key. And that's going to set this spreadsheet off and running and give us a set of distributions over 3,000 different simulations. And we'll get it up here in just a moment. And after 3,000 simulations, what we're effectively doing is taking the same set of assumptions, and we are saying what would be the probability of us breaking even on this trade. And right in here, where I've got the yellow cursor, I know it's a little difficult to read. I can't make that any larger. It says 44.20, which means that what I'm suggesting to you is that under all the conditions that we've set forth, there's a 44% chance that we'll break even or even make some money. Now, what breaking even is good, but it's not that much fun. What's the probability of maybe making $1,000 on this trade or more? And I'm using these little tracers to hone in on about $1,000. So there's very close to $1,000. There's about a 1 in 4 chance, about 25% chance, according to Crystal Ball's running and our assumptions, on making $1,000 or more on this trade. The chances of making a big profit, say a couple of $1,000s, well, clearly that's going to get less and less, about a 14% chance. So there's an 86% chance you're not going to make that much. In fact, let's go the other way. Let's see, what's the probability that we're going to make $500 or less? So I'll hone in, there's $500. There's a 65% chance we're going to make $500 or less. And then, of course, the terrible thing would be to look at, well, what's the chances of us not even making anything or losing? The chance of us losing, breaking even to losing is 56%. And then, of course, the worst case scenario would be losing virtually all of our trade, and even that, we've got about a 1 in 3 or a 31% chance of losing the entire value of the asset. So this is where probability theory enters into our trading. You're going to have to evaluate that. Now, I'm looking also very critically at the mean score, the mean expected score. And on the assumptions that I put in, there's an average profit over a 3,000 size sample that we'd gain $194 on this trade if we did this same exact trade with the same exact assumptions 3,000 times. We would average $194 according to these assumptions. Now, I'll tell you where that's coming from. And you know, if you don't know it, you will in a second, or you probably are guessing it. Where that's coming from is that that's assuming that, remember on the long, on tab option 1, we put in the annual return as 12%. So Crystal Ball's factoring that into its assumptions. It's assuming that, okay, you're saying this trade's going to go up 1% a month, so therefore there's a stronger than average chance. Now, most of the time, in my opinion, and I believe much of the data bears me out, but most of the time we have no idea what an asset's going to do, which is one of the reasons I usually like to run an assumption with the trading spreadsheet with that annual return set at nothing. I mean, you can set it negative by going right there. You can say, well, I think this asset's going down, but I like to see what would happen under the base case assumption that I don't know what's going to happen. Now let's run that same trade and see what happens on our next set of assumptions. So here we go, 3,000 iterations again, and all I'm going to be looking at is that same sheet that we played with a moment ago. So bear with me while I get it open, and that would be, we want net with stop. And let's take a look, first of all, at, well, what are the chances of us even breaking even, which would be if I type in this cell a 0. Before it was 40, I think 41%. Now there's only a 1 in 4. There's about a 26% chance we're going to break even on this trade. That difference is accounted for by the fact that my assumption is I really don't know what this thing's going to do. Your earlier assumption was that you knew that it was going to go up, or you assumed it was going to go up at 1% a month or 12% annually. So that varies our fundamental probability assessments tremendously, because now if you look at the mean expected score or the mean expected trade over 3,000 iterations, we're going to lose $410 per trade. Not gain. I think it was before it was showing a gain of 130 or something. Now we're losing $410. So probability trading has a lot to do with the quality, or should I say it has much to do, if not a lot. I was going to say all, but it's probability theory plus the value of the assumptions, as in any stochastic analysis. And crystal ball is just allowing you to take different looks at it. But rather than just sit there and pretend like, well, you have certain knowledge, or how confident are you in that knowledge? How many times have you run it through a simulation analysis such as we're doing here? Nonetheless, if you believe an asset's going up, what you're going to want to do is to go with your assumptions and see what the probabilities are, and then go from there. So a 1 in 4 chance sounds about right. And then if I go the opposite direction, and then where it says infinity here, I type in a 0 here, that'll shoot me the probability, which of course is 3 in 4. There's a 73% chance I'm going to lose, or break even or lose on this trade. And then the unfortunate part is, you'll notice that what are the chances of me losing everything? Not everything. Well, yeah, losing the $1,200, almost 50%. So you're basically looking at 50% chance of losing everything and a 50% chance of losing a little or gaining some. But your average would be negative. And the reason that's happening is because of the fact of the assumption of the annual input. So there's a small but quick, and I would like to think a fairly good setup on the long call. Now the long put is, as you know, the reverse hockey stick. So toggling back and forth, the call is a hockey stick with the handle going up to the right, and a put, of course, is a hockey stick with the blade on the ice and the handle going up to the left. So if we put in an exercise price, here we're of course hoping that the stock will drop in value. And if we go in and we put in, not 20, if we put in a $2 premium, what we're doing is suggesting here that we think this asset's going to go down in value. It's trading at 50 right now, and we think it's going to go down. So if it does drop theoretically all the way to 0, well, we'll make $48. Cost us $2 to buy the put, and if the asset drops down to 0, we'll make ourselves a cool $48, which is one heck of a large profit. Okay, so as a matter of fact, the reason for I set this spreadsheet up is for my own students, and I thought it gives us a quick review of the trades. The most we can ever lose is the $2 premium times 100. So we can lose 100% of our money, but I always mention to my students that the leverage from the options, which in this case shows a possible 2,400% gain, is truly remarkable. They call options the Swiss Army knife of investments, and I believe that to be totally true. So on the trading spreadsheet, what I want to look at with you now is the long put at the same assumptions. Before we went to trade tab sheet 4, and we saw that the call was $1.24. And then we looked at the put, and for reasons that I explained on the last tape, the log normal distribution, you can see the put at the same implied volatility of 15% will be priced just a little bit different, because a little bit lower, because of the assumptions of log normality. Everything else is the same. So now going to our toggle sheets, let's toggle on the long put right here and toggle off the long call. So we're facing the same trade, except now we're on the opposite side. We think the investment's going to go down. So we play with it one at a time, and there we lost all our money, $1,200, and we lost it all again. And here we're showing where the asset went up. And again, where this asset value is being derived is over a large 395 sample size over the days of analysis. So for example, if you put in a 360-day analysis, you'd be looking at daily trades. What I mean by that is right here. This right here is the model. I'll show you the formula, which is right there, using crystal ball's normal distribution. This is the formula for a move in a geometric Brownian motion model. This is how a stock price would move. So all I've done is put in here 395. I could make it 6,000. It wouldn't make any difference to take the spreadsheet a tremendous amount of time to compute that many price moves. But that 395 is then being spread out. So 60 divided by 395, we're looking at about, this would represent a movement of 1/6 of a day. That's really what's happening. If I put in 395 days up here, if I change this to 395 days, like so, I would be looking at every one of these rows here, here, being a movement on a daily basis. So this was plenty adequate for my trading style, and I assure you I've done enough studying to know that the sample size is large enough to give me very statistically significant and accurate probability assumptions. So I feel very comfortable with it, and I use it mainly for no more than monthly trading anyway. But it will work here just fine. The assumptions will be very good for crystal ball. So on the put, what I click here and I'm looking at the same probability analysis that we just looked at with the call, except now this is based on the put. So it'll run through 3,000 simulations. It'll show me the approximate movement of the stock, which would be this value set up here. Let me get it shaped so you can kind of see there's the one standard deviation point on the low side, and there's the one standard deviation point to the upside, and it's trading at about, looks like plus or minus one standard deviation about 71% of the time. And that again will be due to some of the leptokurtosis that's built into the assumptions. All right, so that being said, what I'm interested in as a trader is, all right, what are my chances of breaking even in this trade? So setting in this column, or this row, will sell right here, 0, that will pop out and tell me, well, you've got a 27% chance of winning on this trade. Very much like the call, but with an expected value of $408 loss. No good. Don't like that. So let's reset the trade again and go back, and one more time. Now let's pretend that we have good information or assessment, analysis, assumption that this asset's going to go down at the rate of 1% a month. If we now run the same test, the same crystal ball test, I virtually guarantee you that what we're going to find out is that our probability of assessments of winning are going to be much higher. And I'm sure you've already guessed that anyway, or intuitively you would know that. And sure enough, from 0, our chances have gone all the way up to, just like they were with the call, to 46%. And that is simply because of the fact that we changed that assumption. So just putting numbers into crystal ball and playing with them, you can pretty much make whatever you want happen, which is one of the reasons that, as I explained, I like to run this with what does it look like if what I said does or does not happen. In other words, what if this thing actually is, I don't know what it's going to do, so I just leave that at 0. I would tend to err on the conservative side, but you can do what you want to, but this will at least give you still an assessment probability-wise on where you've been. All right, this is trading sheet 3, and the reason that I did this was, first of all, we reviewed very quickly what a call purchase and a long put purchase look like and the expected payoffs. We set up the trade using a 60-day trade and 60 days of analysis, and I explained to you how to use this trading spreadsheet with a different strike price rather than what we were using before. You could also, of course, test different strikes, like 49, maybe going in the money call or an in the money put. Or you could go with an out of the money call or an out of the money put. So if you said, well, what if I went with that happens to be an in the money put. What if we went with a 49 put, which would cost me a lot less money? And you could run the same probability assumptions or go on one or two strikes on either side and see, well, where's the best place for me to be? So that's the beauty of the trading spreadsheet, which is what we're looking at here. Again, we have 4 tabs. Tab option 1, that's the long put. Tab option 2, that's the short put. We've got tab option 3, the short call, and tab option 4, the long call. And net, at the very beginning, allows us to trigger and toggle on various sections of the trade that we want, and then either one at a time, if you desire, you press on this big button and you can see what would happen one at a time over the life of that option. And or we can, of course, then bring in the big guns, which would be crystal ball, and see what would things look like over a large sample size to begin to assess probabilities. So that's kind of a review of where we're at. And the reason I'm doing this is that on the next lesson, which will be sheet number 4, or lesson 4, on the trading sheet, what I'd like to do is then go over the short put and short call so that you can see how that's done. And when we can start to combine positions, and eventually we're going to get to spread trading and start to assess the essence of the vertical option spreads, which is the 1.8 SD theory. Then we're going to take it even further and begin to use this trading spreadsheet and go deeper and deeper into more option trading, which is included in the book, and it's coming out in my next book as well, based all on probabilities. So I'm going to sign off for today. This is Charles. This is trading session 3. I'll see you in trading session 4. Have a good day.